Hello everyone. I'm Salim from uh, CFCB section. We are presenting my tech talk on the course Business Economics and Financial Analysis. The topic I've selected for my tech talk presentation is Concept of Liquidity. So let's begin. So let's get on with the introduction of to liquidity and short-term obligations. So basically, liquidity refers to the ease with which assets can be converted into cash. Meeting short-term obligations requires having sufficient liquid assets. High liquidity is essential for financial stability and flexibility. So as you can see in the diagram, basically, it very well explains what liquidity means. So liquidity is basically the ability to turn an asset into cash. So the process of turning asset into cash, the tur- the properties required are easily, it is quickly, at low cost, or for market value. So for the examples for liquid assets are cash, money markets, bonds, stocks, and ETFs. And for the examples for illiquid assets are, for example, art, wine collection, antiques, real estate, coin collection, etc. Importance of liquidity management. Effective liquidity management ensures the ability to cover short-term liabilities. It helps in avoiding financial distress and insolvency. Maintaining high liquidity levels uh, provides a buffer against unexpected expenses. Types of liquid assets. Cash on hand is the most liquid asset as it can be used immediately. Marketable securities such as treasury bills are easily convertible to cash. Accounts receivable can also be considered liquid assets if they can be collected quickly. So some types of liquidity assets are liquid assets, non-liquid assets. So as you saw in the previous slide, liquid assets consist of cash, money that is on hand, investments, such as any stocks, bonds, mutual funds, or ETFs. Bank accounts, your checking, savings, or money marketing accounts. Non-liquid assets include vehicles, a car, RVs, or any vehicle you own, real estate, your home, commercial property, or any land, retirement accounts, such as your 401k, IRAs, or any advantage accounts. Current ratio and quick ratio. The current ratio measures the ability to cover short-term obligations with current assets. The quick ratio or acid test ratio excludes inventory form from current assets for a more conservative measure. Both ratios provide insights into an entity's liquidity position. So these two types of ratios are basically under liquidity ratios. So liquidity ratios basically give an idea about company's liability, company's ability to convert its assets into cash and pay its current liabilities with that cash whenever required. So there are basically four types of liquidity ratios: current ratio, quick ratio, cash ratio, and defensive interval ratio. Current ratio it shows whether current assets are enough to cover the current liabilities. So the formula includes current ratio is current ratio by current liabilities. Quick ratio. It is similar to the current ratio. Yes, illiquid assets like inventory are not considered. So quick ratio is quick assets divided upon quick liabilities. Cash ratio. Cash ratio only includes cash and cash equivalents in the numerators. Cash ratio is basically total cash or cash equivalent divided by the current liabilities. Defensive interval ratio. The ratio gives an idea whether liquid assets are enough to cover the daily cash requirements. The formula is liquid assets upon daily cash requirement. Factors affecting liquidity. Seasonality of business operations can impact liquidity needs. Economic conditions and market fluctuations can affect asset liquidity. Over-leveraging and poor cash flow management can also lead to liquidity challenges. Cash management strategies. Maintaining a cash reserve for emergencies helps ensure liquidity. Investing excess cash in short-term instruments can generate and return while remaining liquid. Managing accounts payable and receivable efficiently can improve cash flow. Liquidity risk management. Identifying potential liquidity risks and, and developing mitigation strategies is crucial. Stress testing liquidity under different scenarios can help access resilience. Establishing lines of credit or access to emergency funding sources can provide liquidity backstops. Liquidity was solvency. Liquidity focuses on short-term obligations, while solvency assesses long-term financial health. A company can be liquid but insolvent if it cannot meet long-term liabilities. Balancing liquidity and solvency is essential for overall financial stability. So basically saw this liquidity ratios in analysis. The cash ratio measures the proportion of cash and cash equivalents to current liabilities. The operating cash flow ratio evaluates the company's liability ability to generate cash from operations. Analyzing these ratios alongside others provides a comprehensive view of liquidity. Benefits of high liquidity. Benefits of high liquidity include high liquidity provides flexibility in responding to opportunities and challenges. It enhances creditworthiness and can lower borrowing costs. Investors often value companies with strong liquidity positions. Liquidity challenges in different industries. Industries with long production cycles may face liquidity challenges due to tied up capital. Service-based industries typically have lower liquidity needs compared to manufacturing. Understanding industry-specific liquidity dynamics is crucial for effective management. So here liquidity challenges include economy faces liquidity challenges, financial intermediation growing slowly, two sources of liquidity, exports and credit lines. Economy requires significant capital flows, which include capitalization of firms, working capital financing, new equipment financing, and new products. Liquidity planning and forecasting. Developing a liquidity plan helps anticipate cash needs and manage resources effectively. Regularly updating cash flow forecasts can highlight potential liquidity gaps. Contingency planning for liquidity crisis is essential for risk management. Liquidity and working capital management. Working capital management involves balancing liquidity and profitability. Efficient working capital practices can enhance liquidity without sacrificing profitability. Monitoring working capital ratios can help optimize liquidity levels. Liquidity and financial statements. Liquidity is reflected in the balance sheet through current assets and liabilities. The statement of cash flows provides insight into actual cash movements. Analyzing liquidity metrics alongside financial statements enhances decision making. Liquidity challenges in economic downturns. Economic downturns can strain liquidity due to reduced revenue and credit constraints. Maintaining high liquidity levels before a downturn can help weather financial storms. Access to alternative funding sources can provide liquidity support during tough times. Liquidity management best practices. Regularly review and update liquidity policies and procedures. Diversify funding sources to reduce reliance on single channel. Conduct stress tests and scenarios analysis to assess liquidity under different conditions. Technology and liquidity management. Automation tools can streamline cash flow monitoring and forecasting. Online banking platforms offer real-time visibility into cash positions. Leveraging technology can enhance efficiency and accuracy in liquidity management. Liquidity and regulatory requirements. Regulators often set minimum liquidity ratios to ensure financial stability. Compliance with regulatory liquidity requirements is essential for avoiding penalties. Monitoring changes in the regulatory landscape is crucial for adapting liquidity strategies. So liquidity ratio basically means a class of financial metrics used to assess a debtor's ability to pay current debt obligations without raising external capital. Case studies on effective liquidity management. Case study one, which is a company X maintained a cash reserve that helped navigate a cash flow crisis. Case study two, which includes a company Y diversified funding sources and improved cash flow forecasting accuracy. Learning from successful liquidity management practices can inform strategic decisions. Here are some strategies for effective liquidity management. Maintain adequate reserves, use short-term borrowings, invest in marketable securities, use derivatives, manage cash flows. Here's the conclusion and some few key takeaways. Liquidity is essential for meeting a short-term obligations and maintaining financial stability. High liquidity levels provide flexibility, resilience, and competitive advantage. Strategic liquidity management is key aspect for overall financial health and risk management. These following three themes have emerged based on hospital strategic properties. Here is an example. So here are few liquidity properties which help in effective and optimizable management of liquidity assets. Cost management and optimizing hospital operations, created collaboration communities with medtech and improving access to healthcare. This is a case study where hospital manages its liquidity assets and liabilities. So we have come to the end of the presentation. Hope you like my presentation. Uh, and thank you so much for spending your time. Thank you very much.